Diversification can be a key principle of investing, and one way to achieve diversification is by including assets from both the public and private markets in a portfolio. While the public markets, such as the stock market, are well known and widely discussed, the private markets are often overlooked. However, private markets can provide unique benefits to investors and could be considered as one component of a diversified investment portfolio. Joining me is Tommy Mancuso with 2020 Advisors in San Diego, California. Hey Tommy, can you talk about how private markets increase diversification?
Yeah, obviously when we look at someone's total portfolio, and thanks for having me as well, but when we look at someone's portfolio and where they're invested, we want to make sure that we're checking all different types of boxes to make sure, one, that we're going to be diversified outside of the public markets. We don't necessarily have control of where the public markets go. There's macro, micro effects. Being diversified outside in the private markets gives us an asset class that will allow us to maybe have some upside when the public markets are a little bit shaky, but also generate a little bit of alpha where we can see a little bit more growth, right? These private markets are in a growing phase in their company. And if you do a good due diligence on the companies that you're going to have that exposure in, you know that they're going to eventually become profitable. And when a company becomes profitable, there's going to be a bigger fish looking to acquire them, and that really generates alpha. Now, we're not saying put all your eggs in one basket when we go into the private markets, but it's definitely an asset class that you want to have some exposure to, just so you're not necessarily tied to the public markets where there's external forces that we necessarily can't control.
And would it be accurate to say that this kind of investing also lowers volatility?
Yeah, so as I kind of mentioned earlier, public markets, there can be geopolitical forces or just technical trading standpoints that will drive those markets down in the public sector. Lower volatility on the private markets is definitely a key factor when we look at these companies. One, when we look at private markets and a quality company in the private markets, we want to make sure that they have an objective, and that's one, to be profitable. And by doing so, they're going to make sure that they're growing, and which has income and everything, and they're just getting started. So that allows them to expand their marketplace when they're able to become scalable. And on that side, we're not going to just see lower volatility. We're going to see hopefully volatility that's driving upwards, because we're not going to have any kind of factors on the downside that are going to drive a particular company down. Right now, when we invest in early stage companies, we want to make sure that they have an objective, and that's go to point A to B, and make sure that they are consistently striving to be a better company than they were the day before. And when someone's putting all those pieces together and makes their company scalable, we really see the positive effects, knowing that we're not going to be having these other outside forces drive our market down or our company down.
So on the downside, would transparency and illiquidity be a problem with private markets?
When we look at the illiquidity, that's the price you pay for being in the private markets. Now, on the flip side, what is the benefits of that? Well, one, you can generate a little bit more alpha, or you can have a little bit more growth in those in those asset classes, in the private asset classes. When we talk about transparency, one, we make sure that our investment team is getting a clear-cut picture into those companies. And I think that's where we were able to weed out the bad actors. And that's extremely important when it comes into the private markets, because there are a lot of private companies. But it starts by peeling back the onion and making sure, if we're going into the private markets, that we are getting quality companies and not some bad actor, as I mentioned, that isn't going to become profitable. So I think when we look at the illiquidity issue, it's the price we pay. But it's one of those things, what is our exit? We always want to have that in mind. And we can set those expectations. Maybe it's 5, maybe it's 7. We're not going to be perfect on that end, but that is, again, what we communicate to the clients in an effective manner, knowing that we have an end goal and we hope to have this be a profitable investment at the end of the day.
Now, in your mind, who is the ideal client for this?
I would say it's obviously someone in the high net worth space, accredited investor, someone that maybe has all their eggs in one basket or just tied in the stock market. Again, another factor is if someone's getting closer to retirement and they're thinking about legacy planning, where we have that long-term time horizon because their kids are going to be the ones that benefit from a private market investment, that's also maybe an ideal client when we know that they can afford to take a little bit, call it 10, 15% of their portfolio and put it in the private markets, knowing that they have a nice buffer on the other side and they're not going to need this money in the short term. And then again, when we look at the private markets, they do typically outperform the public markets as long as we are focusing on investing in good quality companies. So again, that's going to be able to someone not only look out for their future, but set up their family with a legacy at the end of the day.
That's Tommy Mancuso with 2020 Advisors in San Diego, California. This is Retirement News Online.